Take a deeper dive into Actavis' $66 billion deal for Allergan. Bloomberg's Drew Armstrong covers the pharmaceutical industry for us, and Fabio Salvadelli is a Bloomberg contributor, professor at Columbia University, and former hedge fund of funds manager. And Bill George is a professor at Harvard Business School and the former CEO of medical device company Medtronic. He joins us from Minneapolis this morning. I want to start with you, Drew. Walk us through this deal.
Okay, so let's go back a little bit in history. This started out with Valeant offering around $50 billion, $66 billion now. So Allergan has done pretty well for itself in raising this this offer up to about by $16 billion or so. They're going to form up with Actavis, become one of the 10 biggest drug makers in the world. I believe this may be the biggest deal in healthcare this year, and we're seeing, just this huge premium compared to where this started out originally.
What is it about Allergan that was so appealing, not just to Valeant first of all, but to this white knight Actavis?
Okay, one of the really interesting things in healthcare right now, especially in the pharmaceutical sector, we've got a lot of mid-sized players that have, most of their sales in the U.S. are concentrated in just a few key geographies. We've seen players like Actavis and a few others buy these guys up, take the products to new markets. They think that there's a way to take, relatively profitable cash-paying products like Botox and say, you know what, we can sell this in Asia, we can sell it more places in Europe, we can sell it in South America, which Allergan hadn't necessarily been doing at the level that Actavis, with its global operations, may be able to do.
Bill, do you want to weigh in here? Let's look at the Bill Ackman example. In terms of M&A, did we just see a company, Valeant, get played by a hedge fund titan? It almost seems like if there's any loser here, maybe it's them, because he's made over a $2.71 billion profit.
You got it. Bill Ackman has won both ways on this deal. Actually, I believe there's a side deal where they get 15% goes to the gains. The 2.7 goes to Valeant, so about $400 million. But I can tell you that was... Valeant's a house of cards. I mean, it's built on false premises of not doing R&D and things like that, where you have, with Actavis and Allergan, two strong, aggressive companies. David Payot has built a heck of a company. He's got his stock up 23 times in the last 16 years. Actavis has come from nowhere. They originally Watson Pharma, then they bought Warner Chillicott, then they bought Forest Labs, and now their biggest deal ever. And I think Brent Saunders and Paul Bizzarro have built a heck of a company. I'm all for growth companies, strong American companies that compete globally. I'm not for taking companies apart like Valeant would, and I think Valeant's got a real problem. But this can be a very strong combination, very aggressive in marketing. They got something like $1.8 billion in synergies, and both of their pipelines are filled with products because they've been spending money on R&D and innovating, and that's what it takes this field. If you don't, you're in a short-term play, and you're ultimately going to go out of business unless you can pull a rabbit out of the hat.
Fabio?
I mean, R&D, they have an obligation to their shareholders. Pharmaceuticals are different than most companies, but they do have an obligation to their shareholders, a lot of which seems to lead them towards wanting to strip off the R&D side of it, which at the end of the day, marketing is also a big part of the companies. And Valeant, clearly was bringing to the table something that wasn't as valuable unless in combination. And I do think that the argument is, it's a difficult argument to make that it's a house of cards. What they're doing is rolling up assets, and yes, they're shutting down the R&D departments and monetizing those things in Latin America, in Asia, as you said, Eric, and that's a very valuable skill as well.
Is there a loser here?
Fabio?
Bill, is there a loser here really, though? You mentioned that there's a 15%, Valeant takes 15% of Pershing Square's profits. It works out to, I think, slightly north of $400 million. So Valeant was in it, to win it. Clearly, they're not going to bid more than $210 a share. They get to walk away with $400 million. Bill Ackman gets to walk away with $2.3 billion. The only potential loser here is Actavis, and that's only if Actavis screws up this deal.
No, Actavis is not a loser. Valeant, this is a one-time hit for them. They've got to keep the thing going. Back to what Fabio said. If you don't have an R&D pipeline in this business, you're destroying shareholder value. Just look what's happened. Compare Pfizer and Merck. Merck has continued to invest heavily in R&D. They've got a great pipeline, new drugs on the market. They're winning. Pfizer didn't. They cut R&D. They're in trouble, and they just right now buying from Merck KGaA. This is the German company, having to buy cancer drugs. So you have to invest in this business. If you don't, out, you're destroying shareholder value. So I can't see this as a benefit of shareholders. Sure, if you're a short-term investor, cut and run, and just a trader, but if you're interested, as Allergan shareholders and Actavis are for the long term, this is a great deal.
Drew, Actavis makes more sense than Valiant?
I think it may make more sense if you're Allergan. You know, one of their big priorities has always been, hey, we want to try to save this company. You know, we're worried that Valiant's going to take us apart. One of the really interesting dynamics I think we're going to start to see here is Actavis and Valiant really competing on a lot more deals. I sat down with Paul Bizzarro, the chairman of Actavis, about a year ago in San Francisco. One of the things he said, he compared his model to Valiant's. He said, we were very different from them. We're very different. We don't believe in this. You know, some people out there are doing financial engineering. All of a sudden, we're seeing these guys go after the same types of assets. They have the same ambitions to be one of the biggest pharmaceutical companies in the world. Yeah, I mean, well, I don't know if they're doing exactly the same model, but we're going to see these guys coming together on a lot more deals coming up, I think.
And look, the return on equity on money spent on R&D in America has been terrible. You know, it's at best been running single digits, so it might be a precursor to, you know, to lifelong success in the space. But a lot of people are seeing that these assets are not getting paid for the amount of, you know, the amount that you're betting to get that drug is not paying you off under the current environment. And if Obamacare and those sorts of things keep going, the move that Valiant has towards government-controlled assets is extremely valuable. That's why they want Botox. You can still get $200 a shot for Botox. If you've got something that's a government-controlled and under Obamacare, that might be $10 a shot.
And they can continue to jack the prices of vanity products like Botox. No one's asking for discount Botox.
Actually, Bausch & Lomb lenses, all of those kinds of things. Once you're used to that lens, you're not going to change that lens. That's the business model, and it's not really got a lot to do with hardcore pharmaceuticals that are actually government-controlled globally around the world.
So, Bill, do we give Bill Ackman credit for putting Allergan in play, or do we curse Bill Ackman for forcing Actavis, which may have had an interest at some point in Allergan, to step up with a bid of $66 billion?
Well, I think Ackman, like I say, he wins either way, Eric, but I don't think we applaud him for putting it in play, because Allergan was doing all these things on its own. It isn't Valiant that got him to do it. And Fabio, I disagree with you to the extent, I don't think you can look at overall industry average. You got to look at who are the productive R&D shops. Novartis, fantastic. Genentech, now under Roche, fantastic R&D shop. Allergan, tremendous results. My former company, Medtronic, these are the companies that are getting great return on R&D. Okay, there's some, and Bristol-Myers, another one.
Which one of them has given the kind of return that activist investors have seen? I'm sorry, which one of them have given them the kind of returns that investors in Valiant have seen under Ackman? Who's made that kind of money? The answer, nobody. It pays a lot more to spin some of these generic sorts of non-drug controlled ones off. And I think a lot of them, a lot of investors would be looking at and saying, actually, no, some of these large firms are sailing into very difficult waters as they lose control of their ability to price their own products. And it has no correlation to how much it costs them to develop it. So as a business model, I think it's a question, and that's why we're seeing the amount of M&A that we're seeing in the space. Because as a business process, it's not working so well in pharmaceutical right now.
Well, you haven't lost control over pricing of patented drugs. You see the new drugs coming out, they're patented or breakthrough drugs. They have not lost control at all over pricing. They're getting extraordinary margins on those products, and they will continue to do so. That's a sustainable model. My objection to a Valiant is I don't think it's a sustainable model. They have to keep acquiring. That's what Tyco did. My former company, Litton Industries, that was the game, but that game runs out. You get to have ever larger deals, and as you see in this case, they can't make that size deal because they don't have the balance sheet to do it.
All right, Bill, we need to take a break. I want you to stay with us. We're going to cover a lot more when we return. Drew Armstrong, thank you for giving us the latest out of pharmaceuticals, and our own Fabio Salvadelli giving us the inside from the hedge fund world.
Okay.